It's definitely something.
Hey everybody, I'm with Ian from All Star Charts. Ian is always writing on the commodities markets. He has a lot of great stuff on intermarket analysis on Twitter as well. So make sure you guys give him a follow. I'll put his handle on in the description. But we want to kind of go over some stuff today. The market's been quite interesting. Commodities, obviously, everybody's talking about it now, whereas 2 years ago nobody gave a shit about them at all. It was the ridiculous, crazy hyperinflationists, and that was about it. But then, things are kind of playing out. Now it looks like possibly a lot of things look like they're possibly topping. Some things look like they're still running. So we'll see where we end up. So I thought Ian would be a good person to pull on. So we'll get into that right now. So how are you doing today, Ian?
Oh, I'm doing excellent. Thanks for having me.
Of course. Yeah, Ian and I talk a lot about trading, trend following, intermarket analysis. And so we wanted to just have a random discussion today, nothing really formal or in writing per se, but just kind of wanted to bring him on to kind of talk about things like we're seeing all these things in the market right now. And, first off, we were talking about right before we got on, which was trend following and why things are how people kind of complicate trading to these extreme levels because that's what you're told. Like you think you need to read Bloomberg every single day to be a good trader. You need to have the news on behind you all day long. Like as you see, there's no news on here. I haven't watched a news channel while in my trading day, and God knows how long. All these people think all these things. And then Ian was talking about how he kind of found a different form of trading. So I wanted to ask you, how did you find trend following? You mentioned that a little bit earlier.
A friend of mine gave me the Turtle Trader book by Michael Covell, and that's really what sparked my interest in the markets in the first place. It's just a great narrative, great story. And I was really interested in the process and their approach to the markets and the fact that I wouldn't say anyone could do it, but that it was accessible if you were willing and able to follow the program. So yeah, I got really interested in trend following and basically technical analysis. That's what led me to technical analysis. As I had so many questions about how to actually execute, and I was in the process of building my own approach to markets, my own philosophy, and the study of price action just rang true.
Yes. No, that's very true. And it's really interesting that I feel like so many people make things so much more complicated than it needs to be. For example, like you find this thing called trend following. I was mentioning earlier, I think people, when I talk about systematic trading, or they hear about systematic trading, they think of okay, there's this dude in a room and he's got 36 computers and he's coding it all day and he's finding out that there's magical patterns in these markets. And they think of the movie A Beautiful Mind or something. You have all these different numbers going through your head and you're like no, it's much more simpler than that. Basically the first thing we always want to do is diagnose what our time frame is. Is our time frame short term, long term? For me, I like to go through longer term trends. So if I'm doing longer term trends, I want to catch the bulk of the move per year. For me, I think that makes the most sense because it doesn't really matter to me, maybe somebody else, but to me, it matters that every single year you have the end of the year, you have to pay tax on that money. You have to do all of these things. So for me, that 1 year time frame makes the most sense. That could be longer than 1 year, that could be within 1 year, but 1 year time frame makes the most sense. So I'm trying to catch those trends within that year. So what type of system are you going to use? Now we talk about other long-term traders. They use things as simple as 200-day buying, because it sounds so wild sometimes when you're just reading about it, learning about it. But there's some guys who are successful using something as simple as they buy a 200-day high and they sell a 50-day low. Now, if you don't know what that is exactly, that's kind of self-explanatory. But if you have a charting software, if you want to go to TradingView, you could just type in Donchian channel or price channels on stock charts. It comes up. It'll tell you what a 100-day or 200-day high is and a 50-day low. And basically, they're just selling and buying during these times. And so, my signals are a little bit different. I like to use Bollinger Bands. I like to stress out that time frame on the Bollinger Bands from the normal 20-day. It's about 30 or 40 days. I like to also use relative strength and other things to kind of help me with my signals. But I think the biggest thing about it, and something that people don't talk about much in trading, is mental health. Your mental health can be the one thing that will cost you more money than anything else. One, it'll cost you your life, your family, your friends, everything. And trading can become, especially for me, I'm in the futures markets. I'm in 24-hour markets. So being in 24-hour markets, you could go, oh crap, like if I stay up all night, maybe I could get out of this trade a little bit faster and I'll save myself 5 cents. Like it's basically like it gets to be like that. And it's like, so you have to understand how you're going to do these things. And so on top of that simple system, if you're building a trend following system, you have to go, okay, so I need stop losses. So you have to understand if you're going to be looking for that 1 year time frame, your stop losses have to be wide enough to handle all that volatility to not get hit in that very long-term time frame. Now, a way to measure that, there's average true range. You could basically go through it and historically and look at it if you like, but I think multiple average true range, if you just type in 1 ATR, that's going to be too close, but you want to stretch that out to 5 to 10 ATRs depending on your time frame. And then you go, okay, well, I have this amount of room. Let's say it's something like Bitcoin will have a 35% trailing stop. So what that means is that then on top of your system, you're going to have a smaller or a smaller position size. So Bitcoin's going to have a smaller position size. Something like a treasury bond is going to have a bigger position size because that stop on treasury bonds is going to be more like 10%. And so Bitcoin 35%, 10%, huge difference in that volatility. Natural gas could be up to 30%, 40% too, depending, especially right now with all the volatility. So it's, all these things kind of come together in creating this very ideal system. And I think what really comes, like, I could show somebody back tests that this has worked year after year for so many years, with compared to the market, you've had, a few down years where you've had many down years in the market. And I'm talking going back 100 and something years. So this thing over time will outperform the market and do very well. But where people kind of get off the path and they have trouble doing this is their own psyche. Now, I can see it more, and I'm sure you see it because you're writing for All-Star Charts and you get to talk to clients too, is that when people start to see they're completely attached to where the market's going. If their portfolio. If their portfolio is up, they're happy, everything's great. Portfolio is down, they're sad, they're mad, everything's bad. And you have to figure out how to become even in those moments. So for me, I think that having a very systematic way of looking at it is helpful. I think that most people won't be able to do it because you always will think you know better than a system, especially better than a trend. Like, why would I, as a human, you can watch Bloomberg, you can watch all these things and get all this information, but I'm going to take this stupid chart and I'm just going to look at it, and that's going to tell me more than I know. I'm so smart. Why did I go to school and do all these things if I can't even look at this chart and figure out where a stock's going to be in 10 years? It sounds absolutely ridiculous, like when you say it out loud, but it's how people really do think. So I'm sure you deal with that a lot as well.
Oh yeah, absolutely. They're just the biases that even I deal with biases every day, and I catch myself. And luckily, I'm surrounded by a bunch of amazing technicians and analysts, and we constantly bouncing ideas off of each other, and we catch each other all the time.
Yes.
I mean, I don't know how many times over the past year I questioned the rally in the dollar.
Yeah.
I'm looking at commodities ripping higher along with the dollar. I'm like, this doesn't make sense.
Yeah.
Right.
Yeah.
You know, and here we are, you know, dollar just recently printed, you know, fresh highs.
And that's
So
yeah, that's a great point, because you talk to so many people, and I talk to so many people who are like, yeah, this is commodity rally is going to be dead, or all the commodities are going to die because the dollar is going up. And it's like, it's been going up. That's
yeah.
been going up for a long time. Like, I don't understand it personally. Like, if my intermarket analysis signals tell me that this doesn't make much sense, but the price is the price. I mean, it's very weird for me to be short the euro and long commodities. It's odd, but it's just the regime we're in. The world will do what it's doing, and that also has to do with the fact that the inflation we're seeing here, overseas and in Europe, they're seeing worse. So, you know, even though we're seeing it, they're seeing worse. And most people also don't understand the weighting of the dollar. The dollar, you would know, you probably know the exact weights anymore. I'm sure you've seen it a million times.
Yeah, the euros were 56.7. I think the yen's 13 and change, and the pound's 11 and something. So, you know, you have 83% of the dollar index just in the euro, the pound, and the yen.
Yes.
So I mean, and that was the thing, you know, heading into Q2, that's where all the strength in the dollar was pretty much against those three currencies. And as the spring kind of played out, as commodities started to peak, so did the breadth and the strength of the dollar started to broaden.
Yes.
So yeah, it was really interesting to see that kind of play out. And now, I mean, and now the dollars again, there are few currencies that I don't want to be short.
Yeah.
Against the currency, against the dollar. There's very few. I think the Brazilian real,
Yeah.
the Thai baht, which, I mean, that could change later this week.
Yeah. Yeah.
You know,
where that one ends up.
Mexican peso.
The peso is one of my longs. You know, like it's interesting, and it was I remember it was a year ago, whenever the yen broke down, and I remember shorting the yen, and I remember, because even for me, like, we all have our biases, and I don't think I've ever shorted the yen into some sort of commodities driven inflationary cycle, or been, most of the time when I'm long the yen, I'm also long gold and silver, something like, all these things always happen. And this was the first time that I had the signal the opposite way. And I think even a couple of years ago, I wouldn't have been able to just take the signal and go, okay, I'm short the yen. It makes no sense, but I'm short the yen. And I think that comes with time. And it's really tough to fade your own biases. But that's why the price action is so important, because, you know, it keeps you out of doing certain things that may be detrimental to your portfolio. People always are on the internet and Twitter going, oh, you better watch out. You're long this, and it's been going up a lot. You better watch out. Like, it's like, oh, that sounds so ridiculous to me. It's like, you guys are the same ones telling me that you're going to short something because it's gone up a lot. You know, like, and most of the time, if it's not every time, but most of the time, if things are in a good uptrend, they have a tendency of continuing that uptrend. And if things are in a downtrend, they have a good tendency of continuing that downtrend. And that's why it's very hard to find bottoms in stocks. You know, the same people were talking about buying tech, you know, like a couple of years ago, or what was that, 2021, when it peaked out and it came down, you know, 5%. Oh, great deals. Everything's a great deal. You know, Zoom's finally on sale. Zoom continued to be on sale and get cheaper for a very long time. Yeah. So, you know, you have to, the thing about technical analysis, and like, I think there's two different forms of technical analysis. There's the predictive one, which I stay the fuck away from. And if people start talking about that, I'm like, I tune my brain out, basically. Or there's the reactive analysis. Okay, this is in what I consider to be an uptrend. I will then start to buy this position. And when this says it's going to break and I have a sell signal, that's when I'm going to sell it. And I think that's the thing that so many people don't like, because there's people who are like, I hate technical analysis.
Yeah.
And it's like, yeah, if you ran into somebody who's like, yeah, like if I look at this pattern in the universe and like GAN or something, and therefore in 5 years this is going to happen exactly like this, and I know it for a fact, and that's wrong over and over again. Yes, you probably will not like technical analysis, but if you understand it from the fact of these are market participants. People can go on Bloomberg and say whatever they want to say. There's people who go on Bloomberg and say things just to pump things up to sell it all. Like there's all types of fucked up things that happen on all types of media all the time. But what I can see every day is exactly what they're doing. Oh, they're saying energy is dead. There's no more energy. This energy trade is over. You're an idiot if you're still in energy. But I'm seeing that all the shorts are washed out, like because they started moving and started going the other way, and there's no sellers left and there's only buyers. So if that's moving back into an uptrend, I want to be involved in that. I want to be interested in that. And I don't care what this person's saying on TV. It doesn't mean anything because the market is telling me something completely different. And that's where you get and once you start to do it and execute it with real money over and over and over again, then you start to get to the point where you're like, this is making sense. I understand this, because I think the hardest thing for most people with technical analysis is that your brain tells you not to believe this thing you're seeing. You've done so much, you're so smart, because everybody's brain's like that. Like it's to some point, like your brain is telling you that you're smarter than any of these other shit that you've done. And maybe you back tested stuff, but none of that says 100%. And your brain is telling you that, oil has fallen a lot. Wonder if I just pump everything into oil, it'll probably go up to $1 million. Like your brain tells you these things. For example, here's a great one. 2020, best example ever. Oil goes from, what was it, 80? I don't even think it 80. It came down to about $40. And at $40, everybody said oil cannot go any lower. Every single person said that. Every analyst, every person on TV, every person on Bloomberg, everybody said it could not go lower. And if you were a technician, you had the support levels at 40.
Yeah.
But the trend was obviously straight down.
It was.
And everybody going, I'm pretty sure here's a pretty safe bet, can't go that much lower. And then it dropped to 20, and then it went negative in the front month.
I got my limit, or I took profits around 20.
Yeah.
I took profits around 20, and I remember the day that it went negative.
Yep.
And I think I came back from a run.
Yep.
And I was sitting at my desk, and I literally it took me like probably 3 or 4 minutes of staring at my quote board to really grasp. Like I'm like, something's wrong, something's broken here. Like this can't be right.
It's true, and there was so much of that at that time, which it's a perfect example of, you think that in your brain oil is very significant. It is. Your brain isn't wrong there. Oil is a very significant product, so therefore you're pretty safe at buying it around 40. You're buying it around 30. Even 40 to 20, that's a 50%, drawdown. That's pretty big. And if you're in a futures contract, that's very large.
Yeah.
A lot of leverage. You could blow up doing just something like that, and then dropping straight to negative in that front month contract, that destroyed a lot of people. Yeah. So it's, simply put, you could have waited till it turned around, it changed trend. And basically, it was like it had that false breakdown signal. That was a good signal in November 2020.
Yeah. Went
from 30 something all the way to 130. And I think the exit signal was around 105. Like that's a great trade. Made a lot of money. It was a smooth trend. Sorry, it wasn't. It was a commodities trend, which is never that smooth, but smooth for a commodities trend. It was a good trade, but you had to be patient. You had to wait, and then you were right, because that's the thing. You just never know how cheap something can get. Granted, not even in my wildest dreams could I have this. They came up with a scenario for negative oil. I couldn't,
Right.
even in the front month contract, some weird, something with storage. I couldn't have come up with that, but there we were.
Absolutely insane. When you made a point earlier about technical analysis, and there's a predictive branch and then there's a reactive branch.
Mhm.
And I use TA every day.
Mhm.
I'm a member of the CMT Association. I've sat for all three levels of the exams, passed all the exams. I've never used it, and I don't understand the application in terms of being predictive. I have no idea
Yes.
where price is headed,
Yeah.
right? But what I can do is I can pinpoint levels where the bulls and the bears are going at it.
Mhm.
And when a particular level is broken to the upside, path of least resistance is higher, versus when you get a breakdown, path of least resistance is lower. And just be able to react at support and resistance zones. And you also made another point in terms of just being able to change your mind.
Yes.
Right. That's crucial. Being able to realize, oh wait, this is where I'm wrong.
Extremely crucial.
This is where I'm wrong. Let's flip it.
Yes.
Time to go the other direction.
I think that's what's important about what you guys do is the fact that and it's funny, I had a meeting with a friend who I think he knows JC, and he's a good guy, but he said something that I found very odd, which was, yeah, I think JC always puts up stuff about, I would buy, let's say, the stock's sitting at $9. I would buy over $10. I would sell under $10. He's like, I think he does that so he can never be wrong. And I'm sitting there going, that's basic technical analysis. Like, that's how technical analysis is taught. Like, you buy over blank, you set, like, whether it's a moving average, a support level, a flag pattern, head and shoulder, whatever you want to call it. Like, that's the thing, and you're looking for that path of least resistance all the time, and that's good technical analysis. You guys use the CMT, and that's what CMT teaches. Is this is how technical analysis is. This is John Murphy, and those guys. That's how they teach it, because there's been so much of this, magical technical analysis that's going to do this thing for you that's just impossible.
Yeah, no one has a crystal ball.
No, there's certain things that I can put a lot together on, and some people, when I talk about this, some people will kind of come at me because I do say certain things from sometimes, and they'll talk about like something I'll get right. I talked about bonds, and I had a very long thesis about why bonds would top out on March 9th, 2020. I talked about it before that and that day. And like, I nailed the top. Great. But once again, like that could have gone. I made sure even to say that when I talked about it, I'm taking a wild guess. I think that's possible. I'm not selling everything here. I'm not doing anything different here. I'm gonna wait for actual breakdown signal, but I have my reasons for thinking this. Now, to bring up that, after a while, you can come up with certain things that give you higher probability outcomes. And also, those can also be reactionary style technical analysis. Say you're looking at a Bollinger bandwidth, and historically, when bonds get to this certain Bollinger bandwidth, things start to top out. That could be it. There's a bunch of ways you can look at it, but don't think I'm sitting here and going, oh yeah, I really have this feeling because I was watching this guy on Bloom. That's not me.
I actually remember pressing longs a little bit there in the bond market in the spring of 2020. I eventually got it right, but it wasn't until later in the year I flipped it and got short. And man, what a great trade!
Yeah,
what a great trade. 2020 shorting bonds was great. Silver was great in 2020. That was another great market.
The bond trade was quite interesting, and something that I think is an important lesson from this, because if you look at TLT or the 30-year bond, whatever you pull up, if you look at that, this is so right around 2014, I wasn't entirely systematic. I was about 50-50. I moved more and more to the point where I was 100% systematic. And at one point, I remember being short the bond market. And at the same time, you can see sentiment from people. That's the one thing that you can really see well when you're just executing your strategy and going, yeah, I'm short the bond market, because it means nothing to me, like whether I'm short or long. And then I had, I think that was 2015 or 16, I think is when I started shorting it again. And so shorting it, and I got all these people, you're ridiculous, you're an idiot, blah blah blah. And then it hits the bottom, and that was 2018, and we're getting into that recession time where Powell is raising rates in 2018. Everything bad was happening. The market was literally falling apart. People don't remember that because it was kind of quick. But in land of 2018, there was a nearly 20% drawdown in the S&P that happened in a month and a half or 2 months. I think that was October 11th to December 26th. And so when that happened, in the middle of that, bonds started giving long signals again, and they're going, Powell is raising rates, you're an idiot. like once again, it's the other thing. And then I'm long the bond market. I'm basically long the bond market until I think it was maybe August 2020, when that signal started to break down the other way. But that's the great thing about kind of coming up with a good system that helps you with these trends is I don't have to, I don't know anything 100%, but I don't have to guess either. I can go, okay, this is telling me right now I should be short. And then I can also take the sentiment I'm getting too, because it's the same thing throughout the commodities cycle. This is why I also don't believe the commodity cycle is completely dead just yet. I think it's in a normal pattern of getting beat up in the commodity cycle. Like the commodity cycle is going to be nasty. It ain't going to be fun, but saying something's dead or alive is kind of a ridiculous way of looking at it. These are going to go through flat periods. It's going to give a lot of money back. It's going to make a lot of money. It's going to be tough. So I just think that so many people just can't put that piece of this idea together, that instead of being, I was talking about sentiment. So you look at that sentiment wise, every time it comes back, everybody goes, see, stupid. But I've been hearing, see, stupid, this commodity cycle is dead since 2020, since the bottom, and all of these people at the same time. But I like those conversations because it helps me to see their sentiment, and sometimes people have good points. But when you can kind of get that sentiment and see that, wow, everybody hates this rally. My signals are telling me to go long. Everybody hates this rally. I'm interested. I'm automatically like, this is probably a good time to be in this trade. So there's so many reasons to be systematic, and it doesn't even mean to. I always explain it, and I'm sure I said this to you before, like bumper bowling. You don't need the systems to be perfect. You don't need to come in and use them every time like I do, or make your systems always take every signal, sell signal, and so on. Use them as, okay, this is telling me to be long, okay, this is telling me to be short, and from there you can kind of build on it. Even if I'm a shorter term trader, but I have this long-term signal, and I'm going to buy these pullbacks within this that give me a buy signal, something like that. There's a million ways to do it.
Absolutely. I think it's regardless of whether you want to take a systematic approach, a fully systematic approach, or a fully discretionary, or some sort of combination of the two, there has to be a plan. Right? You gotta have a plan, and it has to be rooted in risk management.
Yes.
Without that, I mean,
you're not.
There's no chance. There's no chance, right?
You're not doing anything. You're just losing money, and I think that's the number one thing that I meet from traders that are like, talking of a big game. They're gonna do this, they're gonna do that. It's like, okay, you have to stop, what are your positions going to take out of your portfolio if you get a loss? Like if you take a buy signal and blank and it doesn't work, how much do you lose in your portfolio? They won't know the answer to that. They don't know the answer to where's your stop loss, like or if they do, they're using it in some method that they have just decided to use. Like,
Yeah.
there's people who I always have this, it feels like I have this conversation more than any conversation, and I honestly despise this conversation, but it's here's a trade, Bitcoin, for example, because we already talked about 35% trailing stop. Man, why would you have a stop that loose if you know it's going to change trends? Are you number one? Let's go back to rule one. I don't know shit. Number one, I don't know exactly when a trend will end. My system will never tell me that. I can't tell you that. You don't know that. Nobody does. Maybe some guy on TV tells you he knows that. He doesn't. So then they go, okay, well then I'm going to use the same system, but I'm going to have a 2% trailing stop on Bitcoin. Now, Bitcoin fluctuates 2% every single day. It's the most volatile asset on earth. So you're going to get chopped to death, and they don't understand. I'll explain it to them. It's called the death by 1,000 cuts. Now, there's a lot of traders who made a lot of money in the dot-com bubble. Tons of traders. On the way up, they're making all this money all the time. And then even on the way down, they were disciplined. They used their stops right and so on. On the way down, though, they'd use the same trades. They kept going long on whatever pullback or signal they had, and they got stopped out. And let's say you have a system that's you're only trading one product, which is the NASDAQ. You have a system that's losing 1% of your portfolio. So even if you have that risk control and you're losing 1% of your portfolio, you have 100 trades till you're at zero. And so, lots of people don't understand that. That's also a very tough part. And the only way you learn that is through back testing.
Yeah.
If you take any of the signals I've mentioned, Bollinger Band signals, 100-day up, whatever you want, and if you add a stop loss to that system that is within, 5%. Of nearly any product, but let's say Bitcoin, for example, or oil or natural gas, if your system had a win rate of 75-80%, which is really high, but that's not probably it, but let's say it has a crazy win rate, it'll drop down to about 20%, because you'll make a little bit of money, it'll come back, you'll get stopped out at a loss, you'll make a little bit of money, it'll come back, you get stopped out at a loss over and over again, because your trailing stop will never give you enough space. So that's the one thing I think is so important about risk management. And I think it's why so many people, you have people have the same conversation about stops. They either go, stops are great, I love stops, or they go, I hate stops, I can't use them. They're stupid, stops are ridiculous.
Who says that?
Tons of people. I've had that conversation tons of times. But it's because they're putting their stops so close. Of course you think it's ridiculous, because you're getting chopped to death. And people don't, you have to really understand how those fluctuations, because that's the thing, like, we're not just sitting here and going, oh, we're going to put on this perfect system and we're going to make money every time. We're sitting here and also dissecting what we're in, based on the volatility of the product. That can either be wider or shorter. And that's the same thing with buying, on Bollinger Band top breakouts or 100-day highs, or 50-day lows. This is all going to work with the volatility. Though the bands will get wider, the more volatility, they'll get tighter, the less volatility. So that helps you to understand that. And then with the stop loss, you have to match that as well. So if you're doing all of those things, you're gonna be successful as a trend following trader. But side note, not many people are very successful at trading. So even though there is this thing here that's available to anybody who wants to do the research, there's tons of books. Ian mentioned Trend Following by Mike Covell. There's tons of, Jerry Parker does weekly spaces. There's I had tons
every
of
Friday, right?
Every Friday. There's tons of stuff on it, but still at the same time, I find that very few people can do it. And if they know about it, like, let's say they are fundamental investors and they learn about trend following trading, their fundamental investing will mess it up every single time. I will watch people that are way smarter than I am when it comes to 90% of subjects, but when it comes to finding stocks, they'll find some stock, they'll be riding it. I'll be like, wow, that is a hell of a trade. How are you doing with that? Oh, I sold it 8 weeks ago.
Yeah.
It's gone up, 500% in the last 8 weeks. Why did you sell it? Well, I read about this the other day. And because and yeah, or this was on the news. And because of your biases, like you will, for me, I always say, once you're in a trade, that's when you do nothing. I don't care if, Russia blew up China. I don't care what happened. It's not going to make me sell the trade until I get my exit signal or hit my stop. And I think so many people can't do that. And I watch this happen all the time where they're like, they'll look at a chart and there'll be people who don't read charts and they'll be like, oh, hit a new high. Yep, stupid trade, and for me, I'm like, hit a new high. Better, maybe add to the position. I don't know. I usually don't add, but at that point, it's usually most of the time things make new highs, continue to make new highs.
Yeah.
But I think it's ingrained in us as humans to not be traders like that. And I think that's why it works. Because as a human, you go to the grocery store, you're not looking for something high to buy higher. Like you're looking for what's on sale, what's cheap. If prices are too high, you're like, I don't want that. So I think that bakes totally into why people can't do this and do this very well, and then continue to stick with it. Because that's the thing, like you could, create the best system in the world and start it tomorrow. And most of the time when you start a new system or you need new client money, whatever it is, most of the time it's going to work like crap. I don't know why. It's just something that happens, but you're going to have a month or two of just bad performance. And this happens normally, like it's just something that happens once in a while. But in that 2 month period of time, and your system performs badly, most people will quit and throw it in the garbage and never use it again, even though your system was a 5 to 10 year system, or a 1 year system or something like that. So I think that's one of the biggest problems. I think that's why I always say somebody wants to call me and have a conversation, I'll give you every single one of my signals if they want, but I promise they will never use it for long.
Right.
I could place it on a billboard and say, hey, this works well. This is great. I mean, Jerry Parker could do the same. It's just nobody would stick with it because you see those things and it looks so good from the outside. But then the second things get hard, you're not understanding. My talent isn't the ability to trade well. My talent is the ability to continue to execute while things are going bad.
Yeah.
Things because there is no trading system that makes money all the time.
Yeah, absolutely. And even as a discretionary trader, I can go back and look at the past 5-6 years, and the majority of the time I'm underwater.
Mm-hmm.
And there's usually like a few months where I do well. Yes. And that's like the chunk of my profits for the year. And there's usually it's a handful of trades. Like I can look back and think back what like I was just mentioning in 2020 is like short bonds, long silver. 2021 it was soybean oil. Like that was it's so even again, whether it's discretionary, whether you want to be fully systematic, that's just what trading looks like.
Yes.
I mean, for traders, for young traders, mark's closed. For young traders to starting out to think that they're going to be profitable every week,
right out the gate,
or every month.
Yeah.
Or even 10 years down the road, they think they're going to be profitable every month. It's just crazy.
Oh, it's insane.
That's crazy.
But people just don't understand that as simple as that is to understand. It's kind of like if somebody came up to me and let's say I was a doctor and they were like, hey, I want to be a doctor just like you, Jason. And they'd start tomorrow and they would probably, if they were a surgeon, they'd probably kill 10 people, that's very and nobody would argue that. Everybody would go, oh yeah, of course. Like, I don't know how to be a surgeon. But if you're talking about something like trading, which, I consider to be very, very hard to learn, people think that they're just going to jump in and start killing. You know, it's just it takes time. I think that's the hardest thing about trading is the fact that you have to understand that you are going to pay the market a tuition, number one. You are going to make major mistakes. Two is make sure you're doing it with the least amount of money that you can. But the simple fact that this is difficult and this isn't going to be easy, and not making one good trade doesn't mean you're making money. Like, stop, please, if you're seeing this and you're one of the people who like is screenshotting a trade you won money on, stop doing that. If you want to, if you want to screenshot your portfolio at the end of the year or monthly or something, great. Show me your portfolio. But don't screenshot a trade that went well. There's tons of trade. I've met tons of people who've done nine. Let's say I buy short dated puts on the S&P 500, and I buy puts, and then I buy calls. I could take a picture of the puts today and go, look at me, you know, like I made money, killed it. Like, check out how awesome I am, you know. But at the same time, my portfolio didn't make money, you know, because the calls were the same day, and let's say they went to zero, or if it was a good straddle, maybe it made a couple bucks. Who knows? But the point is that the goal in trading is to make money year after year. It doesn't matter that you lost money in a day. It doesn't matter that you made a ton of money in a day. Are your winners paying you enough to pay for your losers? Because there's plenty of people that, you know, have, let's even say you have a $100,000 account to make it an even number. And if you have $100,000 account, and let's say you take a trade in something and you use options, and you made $2,000 in the trade, you're screenshotting and showing everybody, like, but it's $100,000 account. Like, you know, that's not that much. That's not that big. Great for you, good, but like, yeah, you're going to have to do that so many times to have good returns year after year. And I think so many people, especially new people to trading, like they think that that's how it works. You know, you put out an idea, and if your idea is right, you rub it in everybody's face.
Yeah.
And tell everybody how stupid
they are. Yeah. Yeah. That's not how it works.
Yeah.
But yeah, it's, you know, it's hard. It's hard for people to stick with programs, to stick to the rules, to stick to a strategy, to be disciplined. You know, we have all these biases, and they're basically just shortcuts, right? I mean, we need them to get through the day. They're shortcuts. And, you know, we're so many, you know, it's just, maybe it's just human nature. We're just out there looking for confirmation bias, or looking for confirmation, the confirmation bias. And, you know, they're just going to see what they want to see. They're going to hear what they want to hear. And that's what's so great about Twitter, is that there's so many incredible analysts and traders out there that are creating amazing content that you can go and bounce your ideas off of, and pick them and see what they're seeing, you know, and you can curate that. Right, you can find your favorite analyst for crude oil, or your some of your favorite trend following traders like Jerry Parker, and see what they're saying about the markets, and to see if it jives with what you're seeing, or you know, or if it kind of opens you up to like, wait a second, you know, maybe I'm totally wrong on this market. You know, so yeah, Twitter's a really powerful tool.
Yeah, and I think there's two sides of it. I talked about this in my group the other day, which was just the fact of, I think, because of the way Twitter is, and because of the way the world is now, so many people want to put their ideas in front of others, and I think that that's harmful to new traders. Not people like, for you or me, like, whatever. Like, here's what I'm looking at. If it works, great. Like, if it doesn't, that's it. But this is just what I'm looking at. Neither one of us are predicting, but new traders are like, the market's going to crash. This is going to happen. I am buying puts on this day. The puts will go, you know, make me this much. And they call it out. And I think that colors you so much. One, if you win on something like that, let's say you really don't know how you do it, you really don't have skill yet, you just kind of put the trade on, you don't really know what you're doing. If you win, that will go to your head. You will start to think that you have some sixth sense, and that's how you're going to trade from then on. And
Kiss of death.
yep, exactly. And if you put on those type of trades too, you can also start to really want to hold on to them because, hey, I said it publicly to my followers, and so I said it publicly, and if it's public, that means that I am not getting out of a position. So what I suggest for people who have to do it is you use a trade and say, I'm getting out here. Like, I'm gonna put on this trade, I'm buying it here, here's my exit signal, here's my stop, and put it out like that. Go ahead. But the second you're putting it out and just not saying anything, like, you're just kind of building your own biases into yourself as a new trader. I'm not saying there's anything wrong with that. Putting out ideas is great, but I think so many people get so stuck with it. And if they're having trouble trading, kind of take a step back from all that too. Take a step back from it. Look at the fact that maybe I'm kind of sticking to these things because my ego's sticking to these trades and my price action is not.
Right. I mean, there's I've followed Peter Brandt for a number of years, and I really enjoy his work. And it's something he says, something along the lines of, if you really want to know yourself, become a trader.
Yeah.
Because you're gonna get it all. You're gonna see it all. So yeah, I mean, that's all true.
No, it's absolutely right, and I think that's the one thing that comes up over and over again is that fact that if your ego really gets in place and connects to some trade, and you got to do it, and like you're feeling it, and not to mention, you're not only just like kind of talking about, you're rubbing into people's faces and you're saying stuff like, one, you're an asshole, like maybe don't be an asshole. Like, number two is, I run into that situation a lot, and it's always the same people who are having trouble trading. Like, it's the same person who's kind of like the first one to message me when something will hit a stop loss, and I'm sitting there going like, yeah, I've ridden the thing from 30 to 105. I don't care. Like, they're the first person to message me like, see how bad oil is or something. That type of person is still the one to bring something up to me, a month later, that like, hey, I haven't made money in 3 years, like, or I'm having trouble trading like this, like, or I'm having this issue, I don't know how to build a system, something like that. And it seems like that, if that's the way it is, you're hiding behind that. I'm not making fun of these people. This is every single trader's journey. Like, every trader's journey is like that in some sense. Maybe you're not as outwardly saying these things, but you're having that journey. And so part of that journey is just understanding, like, at a certain point, I don't know anything about the market. I've never met a good trader who's like been like, I get 100% of my trades right. Every trader talks about, I get about 50% of my trades right. The reason why I'm successful is my risk management. Every good trader I've ever had, because I always used to ask every good trader I ever would see, how do you trade well? How do you do this? I want to do this. How do I do this? And they would sell me some book about risk management, and I'd want to just buy the book and burn it. Just because, so you're not telling me the secrets,
it's not fun. It's not exciting.
You're not telling me the secrets. You're not telling me what to pick. But really, at the end of the day, that was the secret. The secret is risk management. Do you know how to risk manage well? Okay, well, you can be any type of trader, and maybe you can even fade every move that a good trader does and possibly make money because your risk management is proper. A lot of people don't understand that.
Yeah, absolutely. And trading is a journey.
Yeah.
And it's, it never ends. No. So it's it's really one day at a time. You got to wake up, every day. I'm like, all right, look, this is my plan. These are my rules. I'm going to stick to them. Yes. Right. And it's easy when you have like an intellectual bias. Those are easy to navigate. But it's the emotional ones.
Yes.
And a great, I think Andy Duke's coming out with a book. I think it's something along the lines of knowing when to quit.
Yeah, I saw that. Yeah.
And because I was, I just went through a lot of stuff personally. I just went through a big move. There was a lot going on. it was a tough time, and I had no business trading.
Yeah.
And I
Yeah.
was just talking to Straza about it the other day. I was like, man, I really had no business trading in July.
Yep.
You know, definitely cut losses short. I think a couple years ago, 3 years ago, probably would have been worse.
Yeah.
You know, but it's a journey and it never ends. Like, you constantly striving for excellence, constantly striving to get better.
Yes, that was well said. I think so many people don't put that into trading either, because they think of trading like a job. Like, I remember there's a kid at a fund I worked at, and he was a day trader, and I don't know where exactly they found this guy. It wasn't my fund. I first put that out there, but seeing him, you could see his trades every week, and like it was like he would check in at 9 in the morning, like on the futures market, and put on like or sorry 9:30, put on trades, not the futures, equities, put on trades at the open over and over and over again every day, 5 days a week, five like over and over and over, like he was checking into a job. And like, I know a lot of like it's kind of funny because you think it sounds funny, like this is on a professional level. This
Yeah.
person who, he worked at other funds before that, but his between the amount of fees that he racked up because of all the trades and everything, he didn't make money. He didn't really lose money, didn't really just did nothing. Probably cost money with all the fees, but it was all because he's just checking in like that. But really good traders, like, you'll have times where mentally you're checked out. Like, systematic will help you with that. Like, you don't really have to mentally check out because you're not executing on your brain. But if it's your own brain, you have to sometimes check out of the markets. And number two, whether you're systematic, discretionary, whatever you are, there's no trade. There's not a trade every day. There's not a trade every day. There's not a trade every week. There's not even a trade every month. Sometimes there'll be a very boring, like good trading. Good trading is boring trading.
Yeah.
Because you shouldn't be. I never look at it like, I'm excited, we're up. I'm so sad we're down. I never see any of that. I have no idea. Like that. For me, I'm trying to stay. I always mention Kevin Durant because I play basketball. Thinking about like Kevin Durant, like you watch that guy shoot, like not exactly my favorite player, but he has one thing about him that's always very interesting to me. If you watch him hit a game winner, he'll hit a game winner, and that'll be it. Like, he's not, everybody else is beating their chest and they got their dance, they're doing everything. Kevin Durant hits it, just walks away. That's just what he does. And I think in trading, like, if you're just executing and you're doing it well, like you don't want to be up like that. You don't want to, because you don't want to be down like that either. You want to be as even as you can be mentally and physically, so you can handle the emotional roller coaster of the markets every day.
Yeah. If anything, when I'm on a run and I'm doing well and I'm up, I get a little nervous.
Yeah.
Because I know what's on the other side. I know what's right around the corner, and it's like, okay, I'm gonna have to, I'm gonna have to start tightening up.
But you don't know.
No, I don't know. You're right. I don't know. But just over the past, 6 years like of experience, I'm like, yeah, I got a feeling like, but yeah, you're right. I don't know, but still, it creeps in there a little bit.
That's the other thing that I think people don't talk about enough, is the fact that when you have these types of things like that, like a feeling like that, let's say you're in the Bitcoin trade from 10 till 60 something thousand, like your brain, that whole trade, whether you're 50%, 100%, like that's all a lot of money, but 100% of that move was anything. So you're 50, you're 100, you're 300, you're 400, you're 500. Like, your brain is telling you that this is going to end every single day. And the only way to really hold on to that is finding some form of system to use. Hey, Ian, you want to hop on again tomorrow?
Yeah, absolutely.
I'd like to add to this a bit more, but I got to run.
Yeah, absolutely, man.
All right. We'll talk tomorrow.
All right. Sounds good.
All right.
Thanks.
All right. So we're back, and kind of one thing we just talked about that we were going to kind of chat through is what we're thinking of the market right now, just from a completely what you do technical perspective, what do you see the market as in? Actually, you know what? Let's start in this whole kind of time frame that we were in, like going from the end of 2020 to today. You know, what type of market has that been? What were the opportunities that you saw, and then maybe what you're seeing today?
Um, I would say, over the past 2 years or 18 months, we've definitely been in a rising rate environment. I think that's the biggest key driver, inflation, right? And, the opportunities were pretty much in the beginning of that phase, like all risk assets. And we saw all risk assets do really, really well into first half of 2021. And then we saw stocks, start to come under pressure, stop going higher. Commodities continued. Can we start over?
Oh, you can go back, do whatever you want to do. Everybody's here to listen, so take your time.
Okay. So the question was,
we were talking about going from 2020 into 2022. So what you were seeing as the market environment is what you were talking about, where we were running. You mentioned that bond yields were the primary driver, and where the opportunities were.
right. So I think the towards the end of 2020, the one chart that really caught my attention were bonds, or excuse me, commodities relative to bonds. That ratio, and seeing that ratio violate a decade-long trend line was really a heads up that the environment was really starting to shift, that commodities were coming back in favor. And then we saw, late 2020, early 2021, bonds really start to sell off, rates on the rise, commodities doing really, really well for the first time in a long time. Stocks are doing really well. And that's something that we've been talking about internally over the past few months, especially in recent weeks, where we've seen inflation expectations continue to hold above their prior cycle highs, above those 2018 highs. Is, when I look at a lot of these charts, I don't see that environment has changed.
No.
We're still in a rising rate environment. Inflation is still very much here. Commodities, we've had some big sell-offs, but they're still in primary uptrends.
Yes.
You can look at some of the base metals, and maybe that's arguable for some of those pullbacks, really, really extreme. But in general, look at the CRB index. I mean, we look at our equal weight 33 commodity index. They're holding in.
I think the one thing that people kind of get twisted, and also don't worry about losing your spot. I lose my train of thought all the time. Everybody's heard me go, crap, got to start over again. Or I'll be driving and recording, and I'll see another I'll start, talking about that. But and once again, like right now, I'm kind of like losing exactly where we're at. So no worries. But I think that's one thing that everybody kind of doesn't understand with things. I think that's where analysts kind of get things twisted and messed up for traders, is everything's got to be so extreme. For me, inflation could just sit here, like that wouldn't be far-fetched for inflation to just be elevated. But most people like to think of it like inflation's either doing this or it's doing this, and there is no this. And 90% of the market is this
most of the time. Right, most of the time. Exactly.
Most of the time. That's a proven fact. But everybody, to have a hot take, to get people to read your newsletter, to get on TV, all of these things, like you got to have this extreme point of view. But if you're a trader, like you got to have the other point of view, which is, this could be really boring for a long period of time. Like this trade that took the fuck off, and let's say oil goes from $30, and let's say it sits at 100 here, like it bumps between 90 and 100 for who knows, God knows how long. That's a lot of pressure on the market. Like that's not a small number, but people would probably, inflation is dead. Look at all, because you either got to be on one side of the camp or the other. I mean, a buddy of mine just sent me one that was a guy talking about, what was it? Natural gas prices in the UK going up, another, to be prepared for them to go up until 2025, like just straight through up, like, and it's like, but that's really like, that's how clients and people outside the markets think of these things. They think we're people who sit in a room and like, we argue with our 6 employees and we then go, man, inflation is going to go crazy forever. Put everything on black, like put everything on natural gas futures and let it run, and that's what they think we do. But really I think the one thing that people don't understand about this type of environment is that inflation will move through things. Inflation will absolutely move from, it was oil, and then it's natural gas. And also these things can go completely opposite directions. 2018 is a great example. You had natural gas explode and oil go down, and a fund that was doing the opposite strategy blow up, because it was so rare for that to happen. And it's just, that's the one thing I see people get so confused about sometimes, is that extremes thing when it comes to trading. Like, and where we're at now, I think things like food is it can be very expensive and get very scarce. The live cattle, these feeders, those have been great trades for us. We've been sitting ever since all the commodities have crashed and there is no more inflation. Like that has been sailing upwards the whole time very smoothly. And so it's like, you don't have to think in these extremes. You just have to go, okay, I have the meats are a long signal. Some of the base metals might be into a short signal. And some things are flat and just there's nothing to do. A lot of commodities, like you said, they're still in primary uptrends. And then some things are to the point where they got stopped down, they're flat, and you're waiting for that next buy signal or the next breakdown signal. But right now, everything I have is so mixed that it tells me that there's more of a possibility of more upside than a crazy crash. And that's all I really want from my systems. I don't want anything more than my systems just tell me, hey, you should still be in this environment. You should still be trading like it's this regime. Don't be afraid to take, like, once again, I could be short the euro and all these things still, but I'm still looking for those trades to possibly move again. If they go the other way, oh well, but I know heating oil has held on. That's still a long signal. Natural gas in the US, that's been nuts. It's just continued and continued and continued, and has made a new high recently. So as everybody's kind of looking through these things, or they'll look right at gold. And I think that's the one thing that really is going to be tough for people to kind of comprehend in the commodity bull that we're in, is 2 years ago was, well, there is no inflation, or 2 years ago there is no inflation, oil isn't moving up. Okay. Then after that it was, there is no inflation, gold isn't moving up. Okay. Then everything was moving up, and it was still, well, you know what? Gold isn't moving up, so inflation obviously isn't really happening, and or gold's confused. I don't know. Like all these people were making up these crazy things, and then you get to today, and it's, well, oil's not moving up, there is no inflation, but all of these other costs are still rising, and it's not even commodities markets are a very demand-driven market. But right now what we're seeing is there's this extreme supply constraints that can become more extreme very quickly because of the state of the world. And so with the little bit of inflation behind it and something unforeseen just kind of happening, a drought, something happening weather-wise to create an extreme spike in heat or cold. Any of these things can set things off just a little bit more. Natural gas being that extremely tight market, I could see it being this major move to the upside for a bit longer. Do I know that? I don't know, but I know it's been a hell of a trade. And if it gets stopped out now, who cares really? Like, you couldn't have asked for a better trend.
Yeah, definitely. I think you're really nailing it in that. One, it's very, very constructive to see cattle doing well, while the majority of the commodity space sold off into late spring. So, and it's going to be really messy.
Yes.
So there's going to be rotation. So that big move off of the 2020 lows that we saw, where everything was working in the stock market, everything was working in the commodity space except for gold. But gold led, right? Gold led, and that's what gold tends to do. And we were talking about this, that I think that gold's going to participate at some point. But I've been saying that for a year and a half, right? So I still think it will participate at some point. I don't know when, and I'm in no rush. Like, what's the rush to buy gold? I was on Twitter the other day, and someone was talking about, I think silver stopped going down for 2 days.
Yeah.
I'm like, oh, silver's up to something. Like, you gotta jump into silver. I mean, silver's making fresh lows right now. There's just, that's the one space within the commodity complex that you just, there's no rush to jump in there.
And that's also, an important point is these things making new lows relatively to the market on top of by themselves. Mm-hmm. That's also very important and very telling. Like, the point that we use those types of things like relative strength for a couple of reasons. One of those reasons is our goal as traders is to outperform the market. Yeah. That's one of the reasons. The other one is it's showing us where money is going, where money is going to be treated best. Money is not being treated best in silver or gold, so that doesn't mean like you guys with, people, I'll probably get an email from somebody who has a brick of gold. Yes, I like physical gold too. That doesn't mean we're talking about trading right now. Doesn't mean I got to have it in my trading account at the moment. So right. No, we're not talking about that. We're talking about in your trading account. As a trader, you don't want to be in these things that are not being treated well, that are not going to perform well against the stock market at the moment. But that shows us that there's no interest in it. Nobody cares about it yet. And at some point, somebody will. And most likely we'll see that turn into, the miners will take a little bit of a jump, and silver might take a little bit of a jump, and then gold might. And we'll see that. That's easy to see. And all of a sudden that will start outperforming the market. And usually that's going to happen on the way down. There's going to be like a down move in the stock market. And all of a sudden you're going to see gold and silver move up for not 2 days, but a couple months.
Yeah.
and against the S&P, they could be completely flat, but against the S&P, they might move up a little bit. So it's a wait for those types of things to happen. And then for me, that's what I'm waiting to happen. And then I'm going to go take a buy signal when it happens. I'm not just going to take a buy signal for no reason. I'm going to wait for that stuff to happen and then take a buy signal. And then hopefully everything's kind of linking together. But most of the time, I think relative strength is probably one of the most important things in your chart list, like
absolutely.
I think most people, they don't really use it. They don't really comprehend it. And honestly, when they see things like, for example, I remember talking to somebody about like copper to gold ratio, how important that is, how it works for me and so on. And they were like, well, logically, I don't know why that makes any sense. And it makes sense, safe haven, but at the same time, yeah, sure, they're both metals. Sure, they both have one has more industrial uses, one has less. But
Yeah.
I could make a thesis for why or why not if I really want to. The point is, if you overlay it with the market, it really is telling, or not even the market, sorry, bond yields,
Yeah.
it really tells you something, where they're headed, how they're moving, more than just about anything on earth. Now intermarket analysis isn't 100%. It doesn't happen all the time. But what we're saying is, if you're able to look at these charts and read these charts well, and then you add one more dimension like relative strength, now you're really kind of taking this thing to the next level of trading, where most people are so one dimensional. And I think having those extra tools, whether it's intermarket analysis, seasonality, fundamentals, if you do that sort of weird thing, um, or whatever it is, I'm not here to really make fun of that, because I know plenty of good fundamental traders.
Yeah.
But it's more of a, if you can add all those things together and kind of mash your signals together, that system that has like a 50% win rate will jump up to about 70% if you're in the right regime. And
Right.
that's what I've learned back testing. I read that first from John Ta- not John Taylor Gatto, that's another person. John Netto. He was in the new Market Wizards book.
Okay.
And he has a book called The Global Macro Edge. And in the Global Macro Edge, he talks about through systematic trades. And he also says, well, on top of it, if you can build the right regime model and get in the right regime, and then still get in the right trades through your system, it will up your win rate, like raise your win rate. And so I thought, he was kind of just saying that up. And I still to this day think he just was saying that. But then I went and actually did the back testing and research and found out that is true. If you can add this relative strength, regime models, however you want to do it, or something on top of your system, and use it in a way that you're not out filtering yourself. That's a very hard thing to do. It's kind of like when people go, I created a system, so to make it really simple, this is just an example, this is not a system to use. But if you're going, I'm gonna use a 100-day high and sell 50-day low, but I'm only gonna wait if that signal is up and over the 200-day moving average. So most of the time when you do something like that, you start to filter yourself out of good signals.
Mhm.
And so that's the one thing that's hard to do when you're starting to add all those things. So you have to figure out how to not like over signal or over filter yourself.
Right.
That's probably the hardest thing to figure out in trading with a system. But once again, that's just something to add there.
Oh yeah, absolutely. I think it makes a good point about just understanding what regime we're in.
Mhm.
And using intermarket analysis is great for that. And we do that in our top-down approach. So we look at all the asset classes and look at it and study how money is flowing between the major asset classes. And then once we understand what kind of environment we're in, then we can start to look at the particular area of the markets that tend to benefit from that environment. For instance, we're in a rising rate environment, right?
Yes.
So we start looking at cyclicals.
Mhm.
And of the cyclicals, energy is the strongest. So look at relative strength. Energy is doing the best. So then, hey, we want to buy Chevron because not just because Chevron's a great looking chart, but because we're in an environment where Chevron's going to do really well.
Yes.
You
Yep.
know, but yeah, and also the intermarket analysis and relative strength studies, it's all about understanding the current, right? Understanding the flow of money, where it's headed.
Yes.
Because investors are going to put their money where it's treated best.
Yeah.
Right.
And I think it has more, like, just to add real quick, it has more to do with that than, oh, this guy on TV said it's going to do best, or I read a book that says it does best when it's at this PE ratio. Like, those things don't work. Those things will not work nearly as well as what you do at All Star Charts, putting that together, understanding that, hey, we go over this chart list every week because that's what we're looking at. We're not listening to where people are saying they want their money to go. We're seeing where money's actually
go. Yeah,
and
absolutely.
that they're also being in the market and watching the price action. You're seeing that they're willing to pay more and more money for those things over other things, and that's
Right.
important aspect of it.
Absolutely. 100%.
Yeah.
I know that, we talked a little bit yesterday about how commodities and the dollar were rising together,
Yes.
and how that was kind of, that wasn't it's not a common intermarket relationship to see those two trend in the same direction.
Absolutely not. Yeah.
So I was thinking about that, and that's what we've noticed, over the past 10 years. And things really changed in the past 18 months, right? The environment has changed, the regime has changed. We're in a rising rate environment, right? So the dollar, I don't think, has as much of an impact on commodities in that environment, right?
Yes.
Secondly, we're talking about the flow of money. Where's money headed? Well, I understand if money's flowing out of risk assets, particularly stocks, that the dollar's going to get a strong bid, especially if bonds are rolling over at the same time.
Yes.
So there's no safety in bonds, and stocks are getting hit. Whereas commodities, there's just not a whole lot of money in commodities.
No.
Right. So I think that's really what's
all the flushes happen the way they do.
Right. That's why that relation, we've seen those two. That's why I believe those two have been able to trend together for as long as they have.
Yes. And it's another interesting thing about what you said, which is, we were talking about the dollar and this not being that normal, but at the same time, it kind of isn't that abnormal. And that's one thing that a lot of people don't really look at, because I'm sure you've looked at it, but if you go back to the 70s, like the dollar comes off of the gold standard, and actually the dollar starts rising in value at some point. I think that was, with that bottomed in 73, rose till about 77, bottomed again in 78, and then had a huge spike into 85, but the end of that big cycle was 82, 83 for the commodities at that point. So it's like, if you go back long enough historically, you can find all types of regimes and things to make sense of all of it. And I could curve fit any of this and say, yeah, this is exactly what's happening, and say we're having stagflation and that's why. But I think the thing that's great about charts and being price action based is that I can just go, well, you know what? Maybe I want to short things against the dollar and buy commodities. It sounds weird, like maybe I want to short the euro against the dollar and the pound against the dollar and these things against the dollar. And as weird as it sounds, I'm still going to be long some of these commodities. But you know what? I will say, like, it really helped smooth out returns in certain periods in the last couple of years for me. Because if you think about being so long commodities, but also then being short some of these currencies and so on, like, it's really like, okay, well, if all of this, as weird as this all is, like, none of these things really will go against, like, they will not go the same direction against me too much. Like, if I'm short the euro and long commodities, there probably won't be a time where, if I'm in the right regime and these are trending the right direction, there probably won't be a time where this switches that hard. So it's a great spread if you can come up with that, but also it's really like, it's psychological. It's like, this can't, I have people, and I always kind of be able to kind of pick somebody's brain quickly if they say something like, I know that this is going to happen. I know that the dollar cannot go up with commodities. I know that commodities are going to crash because the dollar is up. Like, we don't know any of that, like nobody can predict any of those things. But I really, I think this is the best market to really help people understand something about trend following trading, which is not getting wed to anything, being willing to just be long, be long the dollar and long commodities and go, I have no idea why, and being totally okay with that. I could figure, we could talk about why it's not that hard to figure out. Like we talked about earlier, the Eurozone is in a lot more trouble than we are. The dollar is not just weighted only, you know, against, it's weighted mainly against the euro and a couple other currencies. So of course the dollar is going to go up. But if you look at the other currencies like the Aussie dollar, the Mexican peso, the Canadian dollar, even, they're not getting hammered. Like it would normally, people would look at the dollar chart and think those were getting hammered. If you take a look at those, they're pretty flat. They're pretty
Yeah.
boring looking charts. They're not really getting killed. So I think that's something that is really important about this time. It really tells us so much about something that most people don't pay much attention to.
Right. And they normally, don't need to.
Yeah.
Right. They really haven't had to for such a long time. But yeah, it's a really good point. Those commodity centric currencies have held up really, really well.
Yeah.
While developed Europe has actually just gotten crushed.
Oh, crushed. I mean, I'm pulling up the currencies right now. I mean, all of this just it looks horrible. Like the currencies I've never seen, I've never seen such a disparity in all of the regimes. In my back testing while trading, the only time I can compare it to is the 70s. And I think it's because it's so much of people, when inflation happens and everybody talks about the worst regime is deflationary and growth slowing. And I think stagflationary is absolutely the worst regime, because you're talking about, you're crushing the lower class, the middle class, the upper class, maybe some of them might understand exactly what to do. Very few probably do, if we're being honest. So I think this is probably the most confusing regime. So you have a bunch of people running into things like dollars. And most of the time in a deflationary shock, you see the dollar spikes, but that's it. It's just a big spike. Everybody panicked. It was the wrong move and they're out of it immediately. So, this is the regime that can really do some major damage. And the thing that I think people don't understand is, if you were in the 70s, and let's say the inflation rate in the 70s, just to joke around, was 2%, like it was with Fed expectations or something insane, that whatever they say, they're nuts. But it's within that expectation of 2%. The market would have been just straight down, just getting hit over and over and over again, and it would have been bad, really bad. And if you go back and look at it, it's this flat period, it's range bound, and that's because the inflation was so high that even though all of these things normally, with the dollar, with everything going on, would be hammered, this was kind of range bound, and that's what I could see the market looking at now. Now, for the market, we have a good possibility of being very flat here for a very long time, without crazy returns, without anything happening, and that's the most probable outcome. I think everybody wants to see this crazy rally happen, or this bear market forever, and really, like, with just sustained inflation. We don't have to go up from here. We don't have to have hyperinflation. We don't have to go off the deep end and start saying crazy shit. We just can go, there's a possibility that we just have sustained inflation. Unless the Fed somehow has changed the government's policies, let's say we just have sustained inflation. And on top of sustained inflation, the market just stays flat, and the bonds probably still keep getting hit. That's a very probable outcome. Now, there's always a trade to be made. There's always something to be done. The bond yields being, you brought up bond yields, and I was like, yeah, I don't think people, as much as what's going on right now with the bonds and everything, I don't think people are really putting into context that with this market and the inflation and everything that's going on, bond yields are still moving up, and people are still moving out of bonds. Like that's really telling for what the average investor thinks about the bond market right now.
Yeah.
You're in the most fearful time.
Yeah. Definitely, when it comes to the bond market, I'm just keeping an eye on those prior cycle lows, those 2018 lows.
Yeah.
And in terms of yields, when we look at yields around the world, like they're all holding. They're all, European yields came back and retested their 2018 highs, and now they're catching higher. So the whole inflationary environment, it's global in scope.
Yes,
So
the 2018 highs. You're right, and globally,
yeah,
all at the 2018 highs.
yeah,
That's going to be probably the most interesting um, trade over this period, which is one. I'm looking at the inversion on this, and it's insane. I've never seen such a perfect inversion of, the 1 year is at 3.512, 3 year is 3.5. The 2 year is 3.48. I mean, it's literally the most perfect inversion you'll ever see in history. And most of the time, when you have those inversions, prior to contrary belief, the market rises for 6 months to a year. Could be shorter, but that happened also in August 2019. August 2019, we had that inversion that happened. Everybody panicked. It was the end of the world again. There was a big sell-off. If you look at the market, the S&P that time, it's just chopped. And then basically we rallied into the pandemic. Basically, we rallied from the end of August. I think it started in September, and then it ended in February, or when the pandemic happened. So I could see that type of a scenario happening where we have a weird rally out of this. But also, I think one thing that's really important to think about, and you also expand on this, which is coming out of that pandemic.
hmm
I don't think we know exactly how the market or the bond market or any of these things are going to act. We've built an entirely new, like, you would need an entirely new model to talk about government shutdowns, and that's
yeah,
something that we don't know enough about yet. We don't have enough data. You can't back test it. It's only happened once. Everybody's kind of playing it by ear. So it's interesting to see that so many people think they know exactly what's going to happen from this inversion, but I'm saying that this could be a weird one where for the first time we just, we rally through it and we act like it never happened.
yeah.
This could be like normal and we could rally and then plunge. This could be different and we could just plunge from here. I don't know, but it's quite interesting to think people think that they have some idea of what, what happens after a pandemic.
Yeah, I mean, we're in new territory.
Yeah.
Especially with all the the QE. Like, I mean, yeah. So yeah, it's who knows what's gonna happen. We talked about this yesterday. Like, I don't know where the market's going. Like, I study price. I look at lines on a chart.
Mm.
Identify critical levels that I can trade against and that offer exceptional risk reward opportunities. Like, that's what I'm after. But in terms of where we're headed, I think right now it's just kind of a wait and see.
Let's talk about what you're seeing in the charts. What are the charts telling you? What directions are they moving? Stocks specifically, because I know most people are going to be interested in the S&P and so on.
Right. So stocks, the major indexes found resistance at, logical levels. Right. So, it's more whether or not they're gonna hold above the recent pivot lows.
Yeah.
That's kind of what I'm watching. And it could be messy. There's no, it could be messy from here.
Yes.
So, I think in the next few weeks, as everybody comes home from summer vacation and volume starts to pick up, and the Fed's gonna have a meeting next month. I think we'll have a better idea of what the rest of the year is gonna look like.
Yeah.
Probably in the next like 3 to 4 weeks.
Yeah.
And that's the thing. I think we hit on a little bit yesterday. You don't always have to be in a trade.
Yeah.
You don't always have. No position is a position.
Yeah.
Right. So if it looks messy, yeah. Right. There's no shame in waiting for more information.
Yeah. I think it's what's so intriguing about being a futures trader is because for me, there will be times I won't touch the account because there'll be nothing to do, but at the same time, I'm always usually in something
Yeah.
because you're trading so many different markets.
Hmm.
There's always live cattle is trending right now. The euro is trending the other direction, for example. Like there's going to be periods like that. So, the one end of the spectrum, there's still the doing nothing aspect of it. Like I don't need to do anything. I don't need to go in and overthink any positions I'm in. I don't need to add. I don't need to do anything. Let the stops run, wait for an exit signal, call it a day. But it's gonna be quite interesting if people like that, and I watch this happen so much where they just kind of are continuing to jump into things over and over again, or the same trade. Like that. I like, there's all those guys, and I think this is the biggest thing for people to stay away from if you're new to trading, which is if anybody's on there and they're like, I only trade gold miners, I'm only long. Like I only trade gold miners and I'm only long. I only trade cryptocurrencies and I'm only long. I only
Yeah.
trade the S&P and I'm any of that. I'm not making fun of one or the other. I'm just saying like there is certainly not a long trade in one thing over and over again, like
Yeah.
every day. And there's no reason to hold. Like there'll be years where I don't. There's no gold miners in the portfolio, and there could be years where there's no gold miners in the portfolio because I don't see a trade there at the moment. And then, but there might be a trade in live cattle, and then there might not be a trade in something else. And something that I like, liked last year, I might be short this year. That's kind of how we look at things in a way of looking at it objectively, studying the price, and just letting it go where it goes. Like we can tell you that our models are saying most likely there we still could see more upside in inflation. At the most likely it's sustained with possible upside.
Right.
But that doesn't mean that we're in anything that could be putting that trade on. Might mean that we have a couple positions on. That might mean we have zero positions on. We're waiting for buy signals. And something like oil would be an easy example of that. But it's important to always understand, like, it because somebody's talking about it doesn't mean they're in a position, and because you like something doesn't mean you got to buy it. Wait for that opportunity. And I agree with you on the Fed. I think that without the real direction of going, okay, we're going to stop raising rates or we're going to raise aggressively, we don't give a shit.
Yeah.
Like, without one of those, the markets probably are going to be very choppy.
Right.
I think it needs to know there's some assurances. I think there will be. I think the Fed will pivot at some point. I think everybody expects the Fed to pivot. Every time these things happen, everybody expects the Fed to pivot on day one. No, they don't work like that. But I expect them to pivot at some point because it's already too much pressure on the market, and they don't like pressure on the market for obvious reasons.
Yeah. I mean, we'll see. We'll see.
Once
It
again, that's
seems like they have plenty of firepower to be able to continue to hike aggressively, in the near term at least. I don't know.
and
Who knows? Who knows what they're gonna do?
but there's also a good point of you bringing that up, which is they could hike aggressively, and this is the other thing that's interesting. They were hiking. Rates have. Let's look at that. Rates rose on the short end basically from October 2021, and at the same time, and the energy sector rose a lot, and a lot of the commodities rose with it. So this is something that's important to understand about signals. If I was a person that was completely fundamental based, I would look at that and say, oh no, that's crazy. Rates are going up. I better get out of all these positions and, maybe short everything, maybe short all the commodities, and I would have got blasted, like if I would have been thinking, and that's a good thing about what you just said, is that that's also another way of thinking of those things.
Yeah, and you got to trade what's in front of us.
Yes.
Got to trade what's in front of us.
Yeah.
I tried to short crude oil recently, and it was because I got a sell signal, right? It broke a key level.
Yeah.
It started breaking down. And it didn't go. And then, I like when I put a trade on, like, I want to see it go.
Yeah.
And I just recently got a buy signal because it was breaking back up into its prior range. Stopped out of that.
Yeah.
It's messy.
Yeah.
Let's take a step back. Like, okay, crude's gonna figure itself out. I still think it heads higher. I still think we're heading higher in energy. But that doesn't mean I have a position.
Yeah. Yeah, that means you're waiting for another signal. I think the one thing that's also important about what you said, and it's something to kind of tell to traders in general, which is taking those signals. But the way I found every good trader who's really good is every trade they will put on. They don't ever start to go, this is too choppy, this is this. They put on every single trade they have a signal for.
Yeah.
Maybe they might adapt their signals. Maybe like they'll go, you know what, maybe the signal's too short term. I need to stretch it out something because maybe they're getting chopped up too much. But once they come up with their system, they take every single signal over and over again because you don't know what you're going to hit or what you're going to miss. I couldn't have told. I always say this, and I think this sums this up best, which is you never know where your biggest winners come from.
Yeah.
And I remember saying that in 2020. And what's funny is most people now talk to me like I'm a perma bull on everything, which is weird. But 2020, I was very short on everything. I even shorted oil into the negative day on the front month contract. I was one of those people who was
Awesome.
on Interactive Brokers.
Good for you.
Well, it would have been really good for me if Interactive Brokers didn't just go, here's your fucking money. We're not giving you any of that negative money either. But when you basically that year, it was very tough to see, like they didn't say they were going to shut down. And in the US, people looked at that like that's something that happens in China, can't happen here. And so nobody wanted to short the market. Nobody was talking about it, but I got a signal for the VIX. I got a signal for bonds. I got a signal to short oil before anything happened. And then my regime models like to look at things like the KRE against the SPY and so on. And all these things were breaking down and giving me every single signal to be in a high conviction short.
Yeah.
And I took those signals. Now people always go, man, how did you predict the COVID crash? I absolutely did not. I knew nothing about the COVID crash. I knew it was a possibility. I knew what everybody else knows, because that's the thing. If you're reading off of this stuff, you don't have an edge. You're using what everybody else already knows.
Yeah.
So, but what I can see is that breadth was really bad in the market. The bank stocks were falling apart, the KRE. And when those are really leading the way down, most of the time that's bad. The VIX was moving up a lot faster than the market was moving down. All of these things were telling me, okay, well, take these signals into the short part of this and follow it down. And so once again, if I would have sat there and, went, I don't know if I want to, you know what, I've been kind of getting my ass kicked. I'm not going to take some of these signals right now. That would have been a huge disaster, but continuing to take them as they come. Same with from the bottom, at some point, those signals went from short to neutral to long again, and we were still in a shutdown. That would have been, for me, it was easier, and even psychologically, like, man, I don't know if I could do this. Like putting back on positions, we're in a shutdown, like that doesn't make any sense, but the market bottomed, everybody knows what happened after that. So I think continuing to take signals is a very important part of trading.
Absolutely.
Good or bad. You don't like, I'm telling a good story about it, but there's plenty of stories where, oh crap, I got stopped out again. Oh crap, I got stopped out again. That happens because what we're talking about, and while we were talking about position sizing earlier, was because we're just looking at losing 1% of portfolio. And the good trades on average, let's say it makes 5% of our portfolio, and the huge outlier trades, which is what we're really looking for,
Right.
the ones that pay for all the losses all at once very quickly. So, that's all in the realm of the trading space knowledge today.
Yeah. And every trading event is an opportunity to execute your plan
Yeah.
from start to finish.
Yes.
Right. And the more times someone can do that, the more clockwork it becomes, the more boring it becomes.
Yeah.
And that's the goal, right? We want to get to where it's clockwork, following your system, whatever it may be. And trading isn't exciting.
No. No, it's not. You're absolutely right.
But yeah, it'll be interesting to see how these next few weeks unfold. I think it's a good time to lay low. I'm really interested to see how the dollar reacts here. I think that'll be really telling. I think, if the dollar continues to rip, if we see the euro continue to fall, break back below parity and, head down towards 95, then we're probably experiencing another bout of selling pressure in stocks.
Yeah.
And in terms of commodities, those grains look really interesting right now.
Yeah.
Grains look really interesting. Like wheat digging in its year-to-date lows. I mean, corn, is at a level of prior support turned resistance. I mean, soybean oil. I like the look a lot of the grains a lot.
I mean, just in basically in 3 years, and that's not looking from the bottom in 2020. That's literally just August 2018 or 2019. Coal is up 500%. Natural gas is up 300%. Cotton's up 100%. Heating oil is up 100%.
Yeah.
Up near like 87%. All of these things are very unique. And I think that's the reason why it's so important to look at all of the different asset classes, because, for example, this year, if you were mainly a trend follower and you weren't in commodities, you'd be getting blasted. There's nothing else that's really making money one way or the other, even though, yes, some things worked out as shorts, they're not really big money makers. The big money has all been made in the commodities in the last couple of years. So, so many people I think will write all that stuff off and not really care, but basically it's a selling in what regime we're kind of looking at. And I like the way you said that, what we're looking at could possibly put some more pressure on stocks. And what we're seeing in general, for me, I don't, the sentiment in the stock market is the one thing that's really like got me going. I don't know if there's, I don't know. Like I could see a best 6 months period. I can see if I'm really gonna like just speculate and predict a little bit. Let's play the game. Full discretionary, discretion. We're not we don't do that, but just to kind of think about it in technical terms. So if we're looking at best 6 month periods,
okay,
we're looking at that's November till April. So in seasonality, those are the best 6 months of the year usually. And so for me, I could absolutely see some form of scenario where we're kind of flat in this choppy zone, and then we start to actually make a move higher towards the end of this year. And that would be a very possible thing to happen. I could see that being the very probable way this market goes.
Absolutely. I can definitely see that happening.
Just the way it's looking right now.
And what's interesting to your point, November is seasonally the best month for small caps.
Yes.
And small caps were down November 2021.
Yeah.
And that was kind of a heads up for us. We're like, well, wait. Okay. It's when you know, assets don't follow their seasonal patterns. There's a lot of information there. That's it's kind of great to look back and check and see how things are moving versus, okay, well, next month is a really bullish month for crude oil. I'm going to go ahead and buy it even though it's below my risk level. Yeah. Nah, it's not how seasonality works.
No, seasonality is interesting for the fact that what I always say is it's in the land of the blind, the one-eyed man is king. So basically, if you had you can't tell the future, but you kind of have this roadmap that might tell you, be open to the possibility with sentiment this bad. With the same thing. Perfect example is the election cycle is the same way. Once the election is over, the market skyrockets. It almost always happens. 2020 was the perfect example of, holy crap, everybody thinks the world's going to end. I'm literally getting invited to things with people who are like, we're going to find bunkers. And I'm like, right now, why? And it's like, well, there's the election. And like, what's going to happen? People on the left were like, Donald Trump's going to kill everybody. People on the right are like, Joe Biden's going to kill everybody. I'm sitting here looking at all the hedge funds were so short at that time. Everybody from the retails were all short. And I'm going, holy shit. If you add that with the fact that most of the time, now nothing we talk about is 100% of the time. There is no trading system that's 100%. But if you can get it most of the time, and then add to the fact that sentiment is this way and all these things are this way, and that's kind of what I'm seeing now, is that it's kind of the same thing where everything seems like everybody's so beaten down, and that if any type of good news happened from the Fed, the market would probably make a big rally. So
that's the key.
Yep.
You're nailing it right on the head. So the sentiment is a condition.
Yes.
Now we need good news. We need a catalyst.
Yes, we need a catalyst.
We need a catalyst to send things higher.
And we saw a small one with the Fed recently, and I think leading into that was we saw that, decent rally in the NASDAQ and these things recently, but we need a real pivot. And if that happens with the way sentiment is, with everybody being hated, like this rally is completely hated, like everybody hates everything right now, basically. If something like that happened, it would send it a lot higher, a lot quicker.
Absolutely.
And I just don't see that. It's not that I wouldn't be against shorting again. It's more the fact that more money is probably going to be made to the upside than the downside, and I could see that the probable angle is what we're talking about right here. That doesn't mean it's going to happen. That just means that it's what I think is probable,
right?
And that's it.
Yeah, I can definitely see that happening. What's interesting is how quick investors were willing to jump right back into the market off of the recent lows.
Yeah.
We're seeing all these breadth thrusts, these short-term breadth thrusts and momentum spikes and thrusts. So, I mean, investors want to get back in. Investors want to put on risk, but they need a good reason.
Yeah.
Right. It's almost like they're chomping at the bit. The bulls are chomping at the bit, but they need a reason to be out there, buying again.
It's just when sentiment gets like this, I've never seen a scenario. It's not that the market can't go down, but I never see a scenario where the market just gets killed at this point. It's when everything's so washed up and everybody hates everything, and that was a very shallow bear market. Not saying like it needs to be over or anything, but I couldn't see us dropping another 30% from here. That would be, I think that's really far-fetched. I've heard a lot of people calling for that. I think the possibility is more like double bottom, higher low, or a lower low that rips to the upside, something like that, and then possibly moving higher. Or once again, real boring and flat.
Yeah, just kind of messy, and you got areas that are working, areas that aren't. Yeah, absolutely.
What we laid out there, and to go back to one of your points, which was the small caps not doing well in November 2021. That was a great point, and I think a lot of people don't understand why that was significant. So what Ian was saying is the fact that when you have something like he said, he's looking at seasonality. Historically, small caps perform well in November, and then it doesn't. Now, what he's saying is that, okay, this didn't perform well, and then that was the kind of the dinner bell that said the market was going to start falling apart, and then it did. So most of and that's what we can look at. Commodities are super, super seasonal and cyclical. They're extremely seasonal. So when you're looking at seasonality in commodities, that's another good thing to look at is, are they paying attention to the seasonal patterns? Are they doing what they should do? Because there's reasons why, there's refiner reasons, there's all types of reasons why oil does what it does during the year. There's summer driving season and so on and so forth. But when they buck the seasonal patterns, that's telling us something. And I think the first person that I ever learned that from was Larry Williams. Talked about that. He's one of the guys that kind of wrote the early books on seasonality and talked about the fact that when they go against that, that tells us something. So that's something to kind of talk about. Maybe we'll end on that, which is when we're looking at this thing coming up, maybe we do think that there's a possibility of a best 6 months kind of thing, with all the sentiment being as bad as it is, maybe a rally in the fall, something like that. But let's say November comes in, let's say in September is bad, October or flat, October's flat, and then November's down. Maybe that's some way to go, market could be heading down here. Or maybe the market starts rallying in September, which it usually doesn't do that good in September. And then we go, well, the market's bucking this seasonal pattern, so maybe we'll see more upside. So a couple of cool ways to look at that.
Yeah, absolutely. I think it's gonna be really interesting to see, to see if buyers come out next month.
Yes.
It's gonna be really, really interesting. But for right now, hanging tight, sticking with the strongest trends, just the dollar, long dollar, short yen. I don't think you can go wrong there.
No.
You really you can't.
European currencies, long natural gas, long coal, so some of these things that the trends are just holding up well, and sit on your hands and wait for the rest of them to either pick up and tell us something. There's just nothing to do right now. I know things look cheap. I think that's the thing that's bothering a lot of people, is they're like, oh my God, the market is falling. I have to buy it. It's kind of like, I think the best thing that ever happened was 2020. The market has this crazy crash, and trend following signals are not quick. So if you have a V bottom, you're not going to catch the bottom ever. They're just not made for that.
Yeah.
Most commodities don't bottom like that. Most things don't bottom like that. And the S&P is one thing in a million other things. So it is what it is. But I remember it going, yeah, you know what? I'm going to bring up the S&P just to make this easier, because this is kind of important. So if we look at the S&P, and it bottoms at 2000, just above 2000, 2184. And I think my long signal came in around 2006.49. Okay. So at that point, everybody goes, dude, you're going to buy this now? You missed the bottom. Why would you buy now? You missed the bottom. So we're talking about 2,500, basically just over 2,500 in the S&P. Now, that signal was long all the way. It went, S&P went up to 48.31, and then there's stop loss, that would probably be hit around 4,500, somewhere around there, maybe 4,200 at worst. So you're talking about like an absolutely massive trade for a futures index, especially.
Yeah.
And once again, it was just kind of funny. Like, if we just look at it simply buying at the 200-day moving average through 3,000 and selling when it got under it at 4,500, that's still a great trade. Like it's like doing these huge trades like that. So more importantly, just to end on that, which is you're not missing anything when you miss a bottom. Like you're just not like all you're missing is not losing money. You'll have more money. You're welcome.
Right. Exactly. No sense in trying to catch bottoms or pick tops.
Yep.
Just no sense.
Way to lose money.
It's a losing battle.
Yeah. All right, Ian. Good talking to you.
Yeah, absolutely. Thanks for having me.